For our opening session, we are going to be getting a look at something which I know is of real interest and frankly real concern to all of us, and that's Canada's economic landscape. Here with his crystal ball to tell us all about it is the Canadian Chamber's Chief Economist, Stephen Tapp. Stephen, welcome to the stage.
All right, so I am Stephen Tapp, the Chief Economist, Canadian Chamber of Commerce, and it's my pleasure today. I'm going to take you guys through maybe about 20 slides in 20 minutes here. We're going to go over what we're seeing from Canadian businesses as we're talking to them, and what we're seeing in the data from our perch in Ottawa, and what's happening overall in the global economy, and then bringing that back down to what we're seeing in Canada. So let me see if I can advance my slides here with my little remote. So what I want to start about is talking about the overall context and thinking about, in terms of where we're going for the economy, we need to think about where we've been over the last few years with the pandemic. Of course, we've had very rapid shutdowns and lockdowns early in 2020, which had very dramatic impacts. And although the pandemic is starting to wane into the background, it's still having impacts where we've seen elevated levels of folks not being able to absences in terms of going to work. We've seen COVID zero policies in China, which have had major supply chain disruptions, which are now kind of opening up. And so I think it's important to keep in mind that the pandemic, is not behind us yet and is still shadowing the overall economy and the dynamics that we're seeing as well. The pandemic, of course, and the lockdowns had very big impacts and huge policy responses. So on the monetary policy side, we saw central banks reduce policy rates all the way down to their zero lower bounds and engage in a series of asset purchase programs that was used to stimulate the economy. Fiscal policy came through. We've got a picture of the fire hose there. Fiscal policy blasted out a lot of support to businesses and to households early in the pandemic. That has built up some savings buffers, which are still padding consumption in the overall dynamics on that side. Of course, labor market adjustments have been a very big thing. Mar was going to talk a little bit more about the adjustment to work from home that we're seeing and the remote trends that we're seeing as well. But there have been very big sectoral shocks as well, and increases in retirement and those types of things. So labor markets are adjusting as well right now. And then finally, about a year ago, Vladimir Putin invaded the Ukraine. That's had very big impacts, not only on commodity supplies, but commodity prices, food prices as well as those types of things. And in general, when we have too much demand in the economy and we have reductions in supply or challenges with supply, the impact of that in overall economics, we're going to see inflation. And inflation has increased quite significantly. I think it increased a little bit more than most people expected. But inflation is the big thing that the economy was dealing with in 2022, starting to come down a little bit now. And of course, central banks, seeing that high levels of inflation, have dramatically increased interest rates. And so now one of the shocks that we're dealing with is the big interest rate shock from central banks to try to bring inflation back under control. And then what that's going to mean with higher interest rates, higher borrowing costs, that growth is going to be coming down. And so that's the overall context that we're going to be looking at right now for Canada. And so let me talk about some of the business obstacles that we're seeing and we're hearing from Canadian companies through StatsCan's Canadian Survey on Business Conditions. I'm going to list here the top 10 obstacles that businesses are telling us are an issue for them for the next 3 months. And you probably won't be able to see all the details in here, but what you'll note is in the orange columns there, those are things that we've coded as cost-related challenges. So inflation, input costs, interest rates and debt, transportation, insurance, et cetera. Lots and lots of worries about cost-related things. The cost of doing business has gone up quite a lot, and that is a concern for companies. On the labor market side, about 3 of 10 things are labor-related issues. So we have seen a lot of difficulties in terms of recruiting and retaining staff. And then finally, as Perrin mentioned earlier, on the supply chain side, supply chain is still a big problem for a lot of companies. So these are the big things that we're seeing and hearing from companies in terms of the challenges that they're dealing with. And we have been able to track these pain points over the point of the pandemic through the Canadian Survey of Business Conditions. And so what you can see here is movements over time. Cost pressures and labor market issues have all increased in terms of their severity from the start of the recession over until now. Initially, consumer demand was a worry for companies, and that's early in the pandemic, that started to come down a little bit. Although we do anticipate going forward, given slowing sales, that consumer demand will be an increasing concern for companies. And of course, on the finance side, we've seen the rapid increase in interest rates is going to be that financing issues are going to be more problematic for companies. And you see the big up and down and kind of supply chain issues where Supply chain still a problem, still one of the issues for traders, but less of an issue than it was a year ago. So that's how we track the pain points over time for businesses. Let me now talk about the big shock and the big battle that's going on right now with central banks and the economy. What's going to be shaping the outlook is the inflation crisis. We have had inflation kind of serially underestimated by central banks, by forecasters, by economists, pretty much around the world. We thought it would get bad, but we didn't think it would get as bad as it got. This chart here shows the Bank of Canada's inflation forecast from various vintages, going back really early into the pandemic, where we saw concerns about deflation, inflation turning up, going back to the 2% target. But back really around the middle of 2021, inflation started to overshoot the black line there, actual inflation going higher than the forecasted dotted lines of inflation. And you saw that quarter after quarter after quarter where inflation was coming out higher than most expected. We thought, maybe inflation would get in the 4 or 5% range, but things got a lot worse after Putin's invasion of Ukraine. That had very big impacts on energy markets. And so you saw the spike that happened there back towards the summer of 2022. So inflation was serially underestimated, although inflation is expected to come down now, given big comparisons with higher levels of inflation from last year. So I think we need to brace for the full impact of interest rate hikes. This is a heat map that shows us changes in interest rates across a variety of different central banks across advanced economies, starting with Canada up top, the Bank of Canada. First moved in March of 2022, and then got extremely serious through the summer with a series of hikes of 100 basis points, 75 basis points, really outsized moves, which signaled that central banks were behind the curve and needed to catch up. If you look across the Federal Reserve, the Bank of England, the ECB, the European Central Bank, all of the economies and all the central banks have been in kind of similar pickles and trying to get rates up quickly to bring inflation back down. Now, we do know that inflation, interest rates, and monetary policy impact the economy with a lag, which is sometimes long and sometimes variable. In general, an interest rate hike will take, let's say, maybe 4 to 8 quarters to slow demand. It doesn't have a lot of impact on the supply side, but in terms of slowing demand, higher interest rates now and increases that we had through 2022 are going to start to slow demand as we're feeling it now, but also moving into 2023. Some of the initial shocks in terms of monetary policy transmission happen with in financial markets. You see exchange rates move quite quickly in anticipation of rate moves. Borrowing costs, so lines of credit for businesses, household lines of credit, mortgage rates, all those types of things have shot up and reacted almost in lockstep with the movements in policy rates. And so in interest rate sensitive sectors of the economy, such as housing and let's say automotive, appliances, types of things where big ticket items where you're borrowing, we've seen a very strong reduction in terms of sales for those types of things. More generally, goods, which people had shifted to buying goods in the pandemic, those are starting to come down. And then eventually we're going to see services and services price inflation coming down. But this is going to take a little bit of time, and banks are certainly aware of that. I like to think in terms of an analogy where let's say you're flying on business for work, and then you arrive somewhere, you're in a hotel room, and you're looking at the thermostat, and you realize it's super hot. You want to start to adjust those dials to bring the temperature down to where you want it to be. And that's what central banks are doing right now. Although the calibration is not exact in terms of these quantitative easing and quantitative tightening, and then the central bank moves themselves on policy rates. So what they want to avoid is obviously cranking this thermostat down all the way, and then we wake up at 2 or 3 in the morning and we're shivering and freezing because we've overdone it. And so that's where the bank is trying to find that right balance now. Where how do we bring demand back while supply is coming back into the picture, and those meeting and equilibrating so that prices come back under control. So we're going to be waiting for the full impact of those things. The central bank in Canada, so Tiff Macklem, the governor, in his most recent press release and monetary policy report a few weeks back, had made the statement, and the central bank in Canada is probably the first one among advanced economies to move to this conditional pause. Given these lags in policy and the impacts on the economy, they said, we've raised rates very, very quickly from 0.25 up to 4.5%. It's now time for them to pause the increase in interest rates and assess what the overall impact will be as these lingering impacts of inflation, of interest rate changes feed through the economy. And so the Federal Reserve is still going to be hiking rates, a few more hikes expected there, and policy rates getting over 5%. But we are at a point now where central banks have done a lot of work. There's still more work to do, but inflation will be coming down looking ahead. So let me talk, that was the inflation picture. Let me turn now to labor markets. And labor markets, by various measures, you can look at the unemployment rate, or one of the preferred measures that I have is trying to take a ratio between the number of job vacancies. So that is the number of positions that firms are looking to fill relative to the number of unemployed people. If you go back through StatCan surveys in the years before the pandemic, there was typically about 2 unemployed people for every job vacancy. So that ratio was about half. And we've seen in the pandemic period a rapid increase in labor demand. So firms really looking to hire, looking to fill positions. To the fact that we actually have more job vacancies. We did earlier in 2022, we had more job vacancies than unemployed people officially looking for work. In the US, the picture is even more dramatic. There was about 2 job vacancies for every unemployed person. And so what that means, if you're a firm looking to hire, the balance of power, the bargaining power has shifted to workers and employees in this situation. It's much harder competing with a lot of other job vacancies, difficult to hire workers right now. And we see that across the board in terms of labor shortage discussions and the rest of it. So that's the tight labor market that we're seeing in Canada. Let me talk briefly about supply chains and the issues. Like I said, as Perrin mentioned kind of at the opener, we had very big worries about supply chains. Actually, when I started at the Chamber towards the end of 2021, we were looking at data. Here you can see, if you squint really closely, you'll see that there are some vessels that are waiting off the ports of Long Beach and Los Angeles, waiting to unload their cargo and move on. The backlog, so typically would take, in some cases, you'd be waiting a day or two for those types of moves. And that increased about a week or over 2 weeks in some cases in the summer of 2021. So there's a lot of movement to kind of clear up those backlogs, get people working 24/7 to get that along. And then on the other side, in Asia, in China, we had a continuation of COVID zero policies through 2022. And in the spring of 2022, those little dots over there are effectively the same picture you see on the right, just a large number of vessels that are backlogged in the system. By some estimates, we had about 20% of the global fleet looking to unload or load their cargo somewhere off the Southeast Asian ports. And so that was obviously a big concern, a big problem for supply chains, and overall prices of shipping rates shot through the roof. If you look at our supply chain dashboard here, you'll see 4 different indicators. Let's start with the top left, Global Supply Chain Index, which is pulled together by the Federal Reserve of New York. That is bringing together a series of different measures of supply chain challenges. And you'll see the increases over time. Initially in the pandemic in 2020, this shot right up. And then over the course of 2021, and then improving in 2022. But I would say supply chains still normalizing, not normal, still problematic for the shippers and traders that we talk to. When you look at the top right, you see the number of firms that are reporting input shortages, and you trace that back. Typically about 5% of Canadian firms would say that they were having problems accessing the inputs they needed to produce their outputs. That number went up by a factor of 5 or 6 to over 35% of companies. And in early 2022, that was really the peak challenges in supply chains. Things are still, again, problematic. More than 20% of firms having issues. This is affecting a large part of the economy and is restraining growth. Shipping rates on the other side, we've seen this COVID zero policy reversal in China, and some unclogging of ports and some improvements and normalization of demand. So shipping rates that you saw shot up. Again, those are moving up by a factor of 4 or 5 too as well. Those are coming back down. They're not back to pre-pandemic rates, but they're still elevated. But that's going to be, in terms of the inflation calculation, that's going to be kind of coming down on a year-over-year basis. And on the delivery times, we had seen, very slow and uncertain deliveries. Those have improved at this point in time. Okay, so let me turn to the economic outlook now. And looking from the IMF's most recent World Economic Outlook from a few weeks back, the dashed line I've drawn in there at 3% is the line signifying more or less a rule of thumb for global recessions. There's obviously big recessions through the pandemic, and then a very big slowdown in the global financial crisis in 2008. But if you look at an annualized basis for overall global GDP growth, the forecast now is for growth to slow and to be in this mild recessionary territory. Most recent growth estimates of in the high 2s. So subdued growth, not very strong growth, but if anything, we've seen an increase in an upward revision in forecasts for the most recent round of forecasts, given the opening of China. And in the European side, The winter has been actually milder than people were expecting, and that's been good news in terms of the overall energy costs. So, the outlook is not great, but we're expecting things to slow. That's the kind of the global picture. Let me turn to what's happening in Canada. Similar story in terms of things slowing down. The Canadian economy is clearly weakening. The bars there that are in red are estimates of real GDP growth on a quarterly basis. And so you go back towards the end of 2021, GDP was growing at about 7%, which is not sustainable, but coming out of the opening and lockdown periods, you saw very forceful spending. That kind of slowly started coming down. In the most recent quarter we have data for, growth was about 3%. But I've put the distinction there between overall GDP growth, which was about 3%, and overall spending by households and businesses, which actually fell in Q3 given the increase in interest rates. And the pop that we got was really from inventory builds and from trade. So going forward, GDP is on pace for about 1.5%, probably half the pace it was the previous quarter. And then going forward, a lot of economists are looking for growth, possibly mildly positive, given the handoffs we have from last quarter, but not stellar, certainly subdued. So that's what we're seeing in the Canadian side. Let me talk now a bit about, it's a lot of bad news that we've gotten over the pandemic, but I think that there are some glimmers of hope and some things that can give us reason for optimism. First, we've had inflation slowing. So the bank on the left-hand side, looking at 12-month changes, total CPI has gone up to over 8%. It's come back down now to 6.3%. In the most recent data, core inflation kind of moving sideways, but they're around 5%. And the bank and other forecasters are looking, there was a big buildup that we had back in 2022 that I showed earlier. And so they're focused on what's happening right now in the current quarter. And if those things were to continue going forward, overall inflation pressures have slowed. They're not back into the bank's target range yet, but they're back down around 4% in terms of the core inflation, and total CPI kind of coming down more given energy prices. So inflation is clearly slowing. We're in a disinflationary pressure and inflation's peaked. So that's good news. That's the first part of it. We also have some buffers that are going to kind of keep the economy going. So first, household income, given the very rapid and large response of governments, household income actually increased, as you see in this chart here, in the recession. That doesn't typically happen in recessions, as you don't normally see the big outflows of government funds. So incomes went up. Consumers were essentially, trapped in their houses, not able to go out and do the spending and traveling and restaurant meals that they would like to normally do. Consumption fell pretty significantly. And the bottom bars there show the savings. So savings has increased. This is not the case for those in the bottom, let's say 2/3 of the income distribution, but those in the top third of the income distribution generally continued with high-paying jobs, didn't spend as much money going to the office and other things, and they have some pretty strong savings buffers that could be used, even in light of increasing interest rates, to continue some consumption going forward and offset some of those pressures. And then the other side I mentioned before, the tightness of the labor market. We do have a lot more vacancies, a lot more labor demand, a lot more firms looking to hire, about 80% increase in terms of job vacancies relative to pre-pandemic levels. And so what that means is, rather than necessarily having companies lay off some workers, we could see adjustments in the labor market happening as firms are posting jobs, and then if things slow down, they may just not fill those vacancies. And that's one buffer that we see in the labor market happening right now. Let me quickly talk about business strategies as I turn to wrap up here. The first thing that we're talking to companies, and we're seeing a lot of this movement in general, we'll be doing it kind of an annual business planning cycle. Given the fact that we're in a turning point in the cycle, things are slowing down significantly. A lot of firms engaging in some very detailed scenario planning. So what happens if overall sales, don't just slow down, but they fall significantly? What's the business going to do in that case? So a lot of scenario planning happening right now, where of course, with reductions in revenue or reductions in sales coming down the pipe for most sectors, cost-cutting exercises are taking place now. The most visible of that there's been reduction in a lot of advertising revenue online, and that's hit tech companies. And tech companies were also very exuberant in terms of their hiring to ride the earlier pandemic trends. So we're seeing layoffs in the tech sector, but just general tightening of budgets happening across businesses. Now, there's one dynamic here that we think in this recession is going to play out a little bit differently, and that's called labor hoarding. The idea that companies may be less likely to lay off workers than in previous recessions because they think it's going to be difficult for them to rehire workers and go back to the market, given the difficulties that they've had in recruiting. So one way we could see adjustments in the labor market, again, is not necessarily increases in unemployment, but we could see reductions in hours for existing workers. That would be more of the soft landing scenarios that central banks have been looking for. And then finally, companies will be looking to adopt new technologies and digitize and undertake investments as always. But the payoffs of those things and turning points in the cycle may be even higher if they're moving before competitors. So let me wrap up here and turn to my conclusions now, because we've gone through about 20 slides in 20 minutes. So it'd be good for me to kind of try to tie this all together. As you see for the picture there, you see a tree that's sitting there with some snow on it still in the winter thaws. Businesses and households are facing very strong headwinds in 2023. It is not a very good outlook for most businesses in most sectors right now. And the large increases that we've had in inflation have probably peaked, almost necessarily peaked, kind of in the middle of 2022. And disinflation is happening, and overall rates of increases in prices are slowing now, but we're not back to target. We still have a ways to go. The rate hikes that central banks have brought in have been aggressive, and they've been very widespread, so financial conditions have tightened very significantly. And those, of course, are bringing recession risks to the major economies, not only in Canada, but the US, the European Union. China's been very slow as well. So the main engines of the global economy are essentially in slowing down and stalling mode right now. And what central banks are trying to engineer here is a slowdown in demand, and looking for the weakness that we've seen in supply during the pandemic to recover so that overall price pressures can kind of come back into check, back around that 2% target. What we're seeing in the data, and most recently talking to businesses and discussions and looking through high frequency data, we are seeing slowdowns, but the recessions that people had seen as imminent early on has not yet come through. And I'm seeing lots of resilience and some optimism towards the second half to, let's see, resumptions in growth and things picking up. So we're definitely some bumps coming on the road, but the economy bending, but not yet breaking.